This week on the Retirement Quick Tips podcast, I'm talking about how to minimize your own personal stock market risk in your portfolio. Yesterday, I talked about asset allocation, and what I mean by that is your overall mix of stocks and bonds. The day before that, I talked about proper diversification and making sure you don't have any concentrations of stocks or industries or geographic areas in your portfolio. So those are the areas you want to look at first when minimizing your stock market risk. But the last piece of the puzzle really is focusing on the long term. This is so important to manage your stock market risk because even if you retire today, you probably still have 20 plus years of retirement ahead of you. Your investments need to last over that time. We want to maintain a focus on the long term. You hear this all the time. I know it's trite. Focus on the long term, but you hear it a lot for good reason because people often mismanage their risk because they are too focused on the short term. They're nervous about current events, who's in the White House, interest rates, why NVIDIA has been knocked around by DeepSeek, just to name a few recent examples. So when you take your eye off the fact that you have a dual mandate for managing your portfolio in retirement. It's to maintain continued growth and protect your hard-earned earnings. This is a tricky balance because growing and protecting are opposites. It's easy to kind of think, okay, well, I'm just going to protect what I have. In that case, you'll worry more about what's going on in the short term and you forget about the fact that you need this money to grow in order to keep pace with inflation and taxes and other curveballs that come your way in retirement. So your portfolio needs to grow an average. I need to look this up. If you look at your portfolio and then you take off taxes and then you take off inflation, your portfolio needs to grow by it's in the range of like 5 to 6% a year just to break even when you consider taxes and inflation. So you're not having any real growth on top of that. And that's why we need to maintain growth. Because if you stick it in a savings account, if you bury it in your backyard, if you keep it ultra conservative and it's not even giving it a chance to make 5, 6, or 7% a year on average, that's a huge problem because what you'll see is that your purchasing power and your ability to adjust to changes in inflation, cost of living increases, as you fast forward in retirement, 5, 10, 15, 20 years down the road in retirement, you are going to see your standard of living go down if you are too conservative, if you're in the protect only mode. On the flip side, though, if you don't have a focus at all on protecting what you have, if you're just in growth mode, maybe you're near retirement and you still have 80, 90, 100% in stocks, that's problematic too because now you introduce a huge risk. So it goes back to what I talked about yesterday with asset allocation and having the right balance of stocks and bonds. But I think the deeper issue here is that we have to be focused on the long term and knowing that this money needs to continue to grow, but we also have to protect it. In the next big downturn, in the next major recession and downturn in the stock market, we don't want a huge percentage in stocks, like 80, 90%, because you cannot recover as well or sometimes even at all from a downturn in your investment portfolio where you lose half of its value. Okay, do the math. Look, what's your portfolio worth today? If you can't afford to have it lose at least 30% of its value, then you shouldn't be 70% in stocks. You need to be more conservative than that. But you don't want to be like 20 or 30% in stocks or nothing in stocks, because then you can't keep up with taxes and inflation and you're going to see your purchasing power go way, way down as you get on in retirement years. All right, that's it for today. Thank you so much for listening. My name is Ashley Michike, and this is the Retirement Quick Tips Podcast.